Hey there, and welcome to This Explainer. Today, we're taking something that sounds incredibly intimidating, and we're going to decode it into a very logical story, the final accounts of a business. If you want to cut through all the jargon and truly understand how a business reports its financial health layer by layer, you are in exactly the right place. So, if you're a first-year accounting student, or honestly, just someone trying to read a company's financials for the very first time, you might be staring at these massive tables of numbers and feeling, well, a little stressed out. And hey, that's totally normal. But I want to reassure you right out of the gate. We're going to make reading financial accounts completely intuitive. We're tossing out the idea of treating them like a rigid, scary math test. Instead, we're going to read them like a narrative story. Because really, at the end of the day, that is exactly what they are. It's a story about the life and journey of a business. Okay, let's dive into this by looking at our ultimate destination, the balance sheet. Simply put, a balance sheet is a position statement. It's prepared at the end of the year to figure out the exact financial position of a business. Think of it like a financial snapshot. It's a selfie taken on one specific date. It literally pauses time to capture exactly what a business owns and exactly what it owes to others. It's the ultimate reality check for an enterprise at the close of its year. Now, historically, this snapshot was, kind of confusing to look at. Final accounts have traditionally been prepared as two-sided statements. You'd have liabilities on the left, assets on the right, and your eyes are just ping-ponging back and forth trying to make sense of how they relate to each other. It was clunky. But today, a lot of modern firms present them in a much simpler, narrative style called the vertical presentation. So instead of looking left to right, we just read from top to bottom, exactly like you're reading a book. So the crucial point here is that this layout isn't just an aesthetic choice, it's a highly strategic one. This vertical format makes it significantly easier for users to interpret the data. When you arrange the info in a top-to-bottom flow, you're literally leading the reader by the hand through the company's financial logic. It makes judging the profitability and the overall financial soundness of the company so much faster, and honestly, way more intuitive. Part 1. The Profit Staircase. Trading and Profit and Loss Account. All right, let's start the first leg of our vertical journey. Imagine you're walking down a staircase and you're starting from the very top floor. That top floor, that's your sales, the total revenue the business brought in. But you can't keep all that money. To walk down the stairs, you've got to pay your direct tolls. This is the cost of goods sold. It includes your opening stock, any new purchases you made, and direct expenses, minus whatever closing stock you have left over. Once you subtract those direct tolls from your sales, you step down onto a landing called gross profit. It's a great milestone, but we aren't at the bottom yet. We step down again by paying our indirect expenses, finally arriving at our destination, net profit. Now, what's really interesting about this is looking at exactly what makes up that second set of tolls, the indirect expenses. These are the costs that keep the business running, but aren't directly tied to making the product itself. We're talking about paying salaries to your staff, keeping the lights on by paying rent, handling miscellaneous sundry expenses, and covering insurance. By taking our gross profit, adding in any other minor incomes, and systematically subtracting these indirect expenses one by one down the page, we arrive safely at the ground floor. And that ground floor is our net profit, the true earnings of the business for the year. Part 2. The Business Backpack, Balance Sheet Assets and Liabilities. So, with the profit and loss story complete, we transition to the balance sheet. I want you to think of this as the assets and liabilities the business is actively carrying on its journey. The very first things we pack into this vertical backpack are the fixed assets. Notice the heavy gear here: land and buildings, plant and machinery, furniture and fixtures, and vehicles. You're obviously not going to sell these tomorrow, right? You need them to survive the long hike. They form this really solid foundation right at the top of our balance sheet narrative. Right beneath that heavy gear, we pack our current assets. These are the quick tools in our backpack. They're easily accessible, highly liquid, meaning the business relies on them right now for its daily operations. This category includes your stock in hand, your debtors, which are just the people who owe you money right now, cash sitting at the bank, and cash literally in hand. These are the agile, ready-to-go resources the business can deploy immediately to tackle short-term challenges. But as we continue reading down our narrative, we hit a bit of a reality check. We have to account for the current liabilities. Think of these as heavy rocks that have somehow found their way into our backpack, and they're weighing us down right now. These are short-term debts like creditors, the suppliers we owe money to, and bills payable. Since these are obligations we have to settle soon, the vertical format requires us to subtract them from our quick tools. We literally write less current liabilities to show that they are a drain on our immediate resources. And this brilliantly illustrates something absolutely crucial: our working capital. By listing current assets and immediately subtracting current liabilities right beneath them, we automatically generate this vital health metric right on the page. Working capital is essentially a measure of how easily the business can move. It tells you, after paying off those immediate heavy rocks using your quick tools, how much agile resource you actually have left to operate your business today.
Part 3. Funding the Journey, the Financed By section.
Okay, so we've seen everything in the backpack, but let's move to and see how this builds our capital section to figure out who actually paid for all this stuff. To find the owner's true stake in the business at the end of the year, we just follow a simple vertical calculation. We take the starting capital balance from the beginning of the year. Then we add that ground floor net profit we worked so hard to calculate back on the profit staircase. Finally, we have to subtract drawings, which is any money or assets the owner took out of the backpack for personal use during the year. This simple top-to-bottom math gives us the final updated capital figure. Which brings us to the grand finale of the vertical format, often labeled Financed By. This section combines that newly calculated final capital with any external long-term loans the business has taken on. This ultimate bottom line shows the total long-term financing that is supporting all the assets we listed at the top of the page. And do you want to know the beautiful part? The total of this Financed By section will perfectly match the total net assets above it. It neatly ties a bow on our whole financial story, proving that everything the business has is properly accounted for by someone who funded it. So, there you have it. We've walked down the profit staircase, we've packed and unpacked our business backpack, and we've discovered exactly who funded the journey. You no longer have to ping-pong your eyes across a confusing two-sided ledger. Now that you know how to read this story cleanly from top to bottom, I want to leave you with this question. The next time you look at a company's vertical final accounts, how will you use this intuitive logic to judge its true financial soundness? Think about it. Thank you so much for joining me on this explainer, and keep that curiosity sharp.